Nigeria oil marketers propose 550 naira per litre to lift supply from Dangote's refinery. And in the southern part of the continent, we will look at the state of South Africa's electricity value chain. And of course, on the show, we'll be looking at some top business headlines, and we have our guests who will be doing justice to that. This is Business Edge. I am Lekan, Onabanjo. We start off with top business headlines from across the continent. The Naira, Nigeria's currency, on Monday strengthened to 1,230.61 per dollar on the official foreign exchange, despite the decline in external reserves. After trading on Monday, the Naira gained 1.66% as the dollar was quoted at 1,230 Naira 61 kobo, stronger than 1,251 Naira 5 kobo, quoted on Friday at the Nigerian Autonomous Foreign Exchange Market. According to the data released by the FMDQ Securities Exchange, the intraday high closed at 1,261 naira to a dollar on Monday, stronger than 1,281 naira closed on Friday. The intraday low appreciated to 1,200 naira from 1,220 naira on Friday. Dollar supply by willing buyers and willing sellers dropped by 49.43% to $125.55 million on Monday from $248.27 million recorded on Friday. And away from that, the International Monetary Fund said its staff reached agreements with authorities from Ivory Coast on a review of 2 lending programs, which will pave the way for disbursement of $574 million once approved by the IMF's executive board. The IMF said Ivory Coast's performance under its $3.5 billion extended fund facility and extended credit facility program and the $1.3 billion resilience and sustainability facility program had been satisfactory. It said a staff-level agreement had been reached on all policies and reform measures in line with the program's objectives, including further revenue-based fiscal consolidation to reduce the fiscal deficit to 3% of gross domestic product by the year 2025 and on additional structural reforms. South Africa faces an uphill task to escape a global dirty money monitoring list by next year, according to the outgoing Chief Executive Officer of Nedbank Group, Mike Brown. The Paris-based Financial Action Task Force placed South Africa on its watch list in February 2023, citing deficiencies in tackling illicit financial flows and terrorism financing. It gave the country until January 31, 2025 to address the shortcomings. According to Brown, lenders have started doing additional checks on South Africa as early as 2016, when the country's issues were becoming widely known, meaning the FATF's decision made little practical difference. Nedbank is one of the nation's largest lenders by assets. Finally, ZiG, Zimbabwe's new currency, began trading on Monday as businesses struggled with the nation's 6th attempt at introducing a revamped unit. Zimbabwe Reserve Bank Governor John Mushayavanu set the introductory exchange rate at 13.56 per US dollar for the ZiG, short for Zimbabwe Gold, where it started trading. The interbank market will set the daily exchange rate from now on, Mushayavanu said during an April 5 presentation of the monetary policy statement. Only about half of the nation's 19 banks are expected to be able to process ZiG transactions by Monday morning, according to Zabron Chilakala, the Chief Executive Officer at ZimSwitch, the national payments platform. ZimSwitch allows individuals to send 2,400 ZiG per transaction, that's about $176, and 8,000 ZiG a month. But now go on a break to bring you market updates. To stay with us. Nigerian stocks extended their recent slump on Monday, April 8. Continuing the bearish trend, many investors opted to sell at the start of the shortened holiday week. The market fell 0.38% or 222 billion naira by the close of trading, pushing the year-to-date return down to 37.81%. So at this point, we look at the numbers, starting with the all-share index, and there we have it. It's closed at 103,047.23, with, of course, what I said, minus 0.38%. A quick look at the market capitalization. We see it still hovering at around 58 trillion threshold for the market capitalization. And of course, we look at the top price gainers for yesterday. Meristem takes the top spot with 2 naira 33 kobo, followed by Omatech at just about 84 kobo, and CWG rather at 7 naira 15 kobo, followed by Linkage Assurance at just 95 kobo, and Sterling NG with 4 naira 95 kobo. And you see the percentage differential of single digits, +9, +7, +5, +5, and of course +5 for the last stock. We look at the top losers for yesterday. That is Abe BDS topping the charts with 2 naira 50 kobo, and Champion, of course, closing at 3 naira 36 kobo, followed by Regalings at 35 kobo. Chams Cornhall PLC closing at 2 naira 6 kobo and 1 naira 46 kobo. And then you see the differentials in the negatives. Before we go look at the sectoral performance, and of course, we have the banking industry with a percentage differential of -2.67%, followed by insurance, and oil and gas are actually bland. Consumer goods with about -0.27%, industrial goods, well, you know what it is right there. And that is how the Nigerian bourse performed yesterday. When we go on a short break and return, we'll look at top business headlines. To stay with us. On our first conversation today, we'll be looking at some stories that are on the headlines, and Gospel Obele, Chief Economist, Streetnomics, is joining me from London, United Kingdom. Gospel, thank you so much for joining us. We will start by looking at the CBN's ban on foreign currency as collateral for Naira loans. So tell us, how will this policy affect businesses that rely on foreign currency earnings but need Naira loans?
Well, it will definitely impact on bottom line in terms of being able to access capital. The truth is the central bank is also pressed for options, and quite frankly, there've been loads and loads of round tripping and artificial holding of the dollar across different points of exchange, which has impacted on the exchange rate, as we've seen previously in weeks. And the central bank has been out recently to sort of tame all the critical points through which that supply demand dynamics has been hijacked by interfering forces, not necessarily market forces now. So, and it's part of what we're seeing now. Now, the fear is that the policy is sort of seeking to go really extreme, to clamp down on everything entirely, than probably trying to figure out the leakage points across this value chain in order to sort of mop them out and deal with them. So it's a tricky trade-off reality for the central bank and stakeholders who are involved. But what this definitely will mean will be higher cost of accessing capital.
Now, talking about interference and the higher cost in accessing capital, do you think that would also affect loan availability for certain sectors? Some people have said that it probably might decrease the possibility of having some sectors or some players in the sector access this loan. Do you think that would also come into play?
Yeah, that would actually definitely lead to some restructuring on how loan is being mobilized, disbursed, in fact, who assesses what and why. Do not forget also that all of these dynamics are happening in the face of increasing interest rates. So with the rising interest rates also means that some people are already cut off the block. So it's a moving or developing story that, we're literally waiting to see how it plays out, as we move on to the coming weeks. But definitely with rising interest rates and this new development, it will reorder and restructure the lending economy in that space, definitely.
So now that the policy has been rolled out, can the CBN offer alternative collateral options for businesses that may not have sufficient Naira denominated assets?
Well, that would have been my assumption at start, or the safety assumption, meaning that you create a buffer solution so that when you go full scale on the policy, those who need it the most can find a safe haven. But again, if you take a cue of how policies have been rolled out in Nigeria, realize that the action is being taken first, then you find the reaction, then you find the effects of those reaction or the action itself, then the institution now begins to think of all possible intervention. So at this point, it's already late to begin to think of what interventions, not necessarily already late, interventions could still be rolled out, but it would have been more preferable if those interventions were introduced way before, if consultations were also engaged to sort of introduce interventions way before the policy was rolled out. Again, even if you introduce interventions way before, we're not so much of a system who really engages stakeholders significantly, because you also want to talk about how do we identify those who really need that intervention, such that they will be the ones benefiting from intervention, while we sort of take out those who are really leveraging on the leakages to impact on the exchange and all of that. So it's a very difficult and painstaking work to do, which again, quite honestly, the central bank doesn't have the time, because the point at which the Naira was really skyrocketing at the time was so bad that loads and loads of aggressive moves needed to be taken. However, that aggression as well has led to some form of trade-off of some bits that are not necessarily pleasing to the eyes of some critical real sector stakeholders.
So this will mean that these interventions by the CBN will help strengthen the Naira and also help in managing foreign exchange reserves. Is that what you mean?
Well, not necessarily. Not necessarily, because all of these interventions are geared towards blocking leakages and curtailing and moderating the exchange. And moderating here would also mean that you're trying to take out points where artificial scarcity may have happened, hoarding may have happened, points where people may have greatly impacted on the exchange internally, the economy, and all of that. So they're just trying to take out the pain points, safe to say, take out the heavyweight pain points that are triggering effect on the exchange. So that's where moderation comes in. However, moderation doesn't necessarily mean that the value will skyrocket and will be sustainable. All right. Moderation would definitely reflect on the exchange in terms of the Naira may appreciate, but the Naira in the real sense is not really appreciating. We're just trying to moderate and balance out on market behavior. So for the Naira to truly appreciate, we now need to look at the sustainability element of these policies. And that will actually latch heavily on productive economy, a local productive economy, and if possible, rolling out initiatives as well that would disincentivize people from needing more of the dollar to do things. All right, and which is where the fiscal policy comes in. All right, so the future of the exchange, you cannot take out that partnership between the monetary and fiscal policy from the future of the exchange. You can't also take out the partnership between the official and parallel market working in sync for the future of the exchange. So it's way beyond these moderation initiatives, again, which are key to sort of reduce on the trigger points of the exchange.
So the other side of this legal tender, Nigeria's legal tender, the other side of this discussion is the CBN selling dollars to bureau de change operators at 1,101 naira to a dollar. So we know that the CBN is selling forex BDCs at a discounted rate of 1,101 naira compared to the current market price, which is, well, likely higher. So how much of an impact do you think this will have on narrowing the gap between the official rate and market rate for end users?
Again, the central bank is really on the moderation drive, and that's what we've seen in many of its policies. The discounted rates are a good move, but again, not sustainable. Not sustainable because many of the dollars that are going into that discounted engagement are actually taken from external reserves at other points. Although, lucky enough, oil price has moved up to over $90 per barrel, which can be a plus, but you don't also want to take in money you should be saving for the rainy day for short-termist interventions like this. So yes, the discounted approach will work in terms of moderating of the exchange, and we've been seeing the Naira fall significantly in recent days. So it's a good short-term approach, but again, it's not sustainable, because how do you want to keep financing it, and for how long can you keep discounting that process? All right. So and then I also, that in a way defeats the approach to lead the Naira to float. So you have the market forces trying to take its weight, but then again, the apex institution trying to control how market forces are working by discounting from the parallel market. So what we need to do at the end of the day, whilst we're doing the short-termist engagements, I would have preferred we rolled out these short-termist engagements, but you have an aggressive national emergency plan or action to to sort of ensure that the economy is productive, leveraging on our low-hanging fruits. Once we begin to do that side by side, then we can rake in more dollar supply into the pool of the foreign exchange reserves, as the case may be, and also encourage local production and consumption. That way we can begin to balance some of these effects. Again, taking into consideration that the demand for dollar, skyrockets or sprouts across different sectoral needs like healthcare, education, and many things like that. So whilst we can't control all those things, we can at least tame it to a reasonable point, But then again, I think the central bank is doing a lot of good work, but it's in one direction only. There has to be a balancing out approach if we must have anything sustainable within this context of, the discounted initiatives.
All right, the last part has to do with Nigeria getting green light for a final $1.05 billion loan to relieve foreign exchange crisis. First, are you in support of the loan facility as a viable means of dealing with Nigeria's forex issues?
Well, I'm concerned about the sustainability approach of these things because it doesn't make it, if you're borrowing or raising those loans to pipe directly into the productive streams or the heavy return sector streams of the economy, that's a different conversation. But you're taking it to fix a very local, faulty, structural deficient challenge that we have. Now, I wouldn't say it's completely bad because, to be honest with you, the central bank is also running out of options. So, as something must be done on the exchange. So, at this point of survival, what needs to be done must be done. All right. So, the central bank is doing what it needs to do to stabilize on the exchange.
So basically, it's not a win-win situation.
It still brings us back to the problem.
So what you're saying basically is that it's not a win-win situation. It's just a stopgap that probably might bring on some, negative effects later on. Is that what it means?
It's a moderation approach by the central bank because, thinking about the Naira at 2,000, that was ridiculously high. All right. So it's a moderation approach, which is necessary. It's not the best of approaches, but it's a necessary survival approach. However, in the mix of all of these, because it's similar to the discounted engagement they're having with the BDC, it's similar to many of the policies we've been hearing recently. All right, so they are all in a bid to moderate the market, not necessarily stabilize or reduce the exchange rate to a point where it looks like the Naira is gaining significant value. The Naira is still not gaining any value. All right, the Naira can only gain value when there's a sustainable economic value approach to how things are going to be done.
Okay. Now, we said that the loan of that $1.05 billion is repaid with crude oil shipments. Now, could these arrangements limit Nigeria's ability to sell oil on the open market and potentially capture higher prices?
Well, on that particular argument of being able to sell oil, my thought will be that possible permutations have been done. Possible behind the camera conversations may have happened, all right, to be able to keep that sale of crude oil going, because you don't want a situation where we're also dropping in revenue, which has been a major issue for years now, fixing our revenue. And this administration is quite keen on raking in revenue. So all revenues and selling of crude oil and all of those things would actually keep happening. What I see happening a lot of times will be possible compromises will be done along the way. Now, anybody who thinks that Nigeria would get out of this current economic quagmire without making some compromise would be making a fool of him or herself, all right? But then again, compromise are not necessarily bad. It's just an argument of trying to pull the weight between win-win, win-lose, or lose-win, as the case may be. All right. So compromises will be made. And I see that on the grounds of those compromises, I think crude oil will still make passes, in as much as some parts or some stakeholders will find it challenging.
Okay. Gospel Obele, Chief Economist, Streetnomics, thank you so much for sharing your thoughts with us.
Thank you for having me. Appreciate it.
And those are the top headlines that we just touched on the show. We'll still be talking about oil anyway, but then we'll be looking at what the marketers are presenting to Dangote Refinery in terms of pricing, 550 Naira. And the ordinary Nigerian on the street will be wondering, how much will I eventually pay to purchase fuel at the filling station? Let's find out from our guest after the short break. Nigerian National Petroleum Company Limited and Dangote Refinery are working together to address petrol scarcity in Lagos and surrounding areas. Now, Dangote Refinery, with a refining capacity of about 650,000 barrels of crude oil per day, is planning to commence production and distribution in May 2024. The parties, as we know it, involved are currently discussing pricing, distribution, and margins. It is anticipated that locally refined petrol will be less expensive than imported petrol due to the local availability now of crude oil and the elimination of transportation costs. This morning, joining me to discuss this is Esther Otusanya, Senior Investments Research Analyst at Meristem Securities Limited. Thank you so much, Esther, for joining us.
Thank you for having me. Good morning.
So we know that meetings have commenced on what the price peg should be for the locally refined crude, and a proposal of 550 naira per litre has been tabled by the marketers. Considering running costs for both Dangote Refinery and the marketers, do you think the proposed price is fair?
There are different variables that feed into the determination of the price of PMS, and from Dangote's point, there's the cost of acquiring the crude oil. There's also the refining expenses and logistics as well. But when you look at from the part of the oil marketers themselves, they have to assume the distribution and marketing costs from their end as well. So this cost can actually vary across marketers, with some marketers able to optimize their logistics and minimize expenses than others. So under the deregulated downstream sector, we may see a different range of prices eventually, because when this refined product is transported across the country, it might the prices might vary across the country. So, but these price differentials will not necessarily be so large. It's expected to be narrow due to competitive pressures and general market dynamics in the sector.
Okay, so according to reports, depot owners currently buy the products from NNPCL at 556 naira per litre and sell to independent marketers at 640 naira per litre. We know what's happening backdoor as regards subsidy payments anyway. But if an agreement is to be made and we are going to look at all the dynamics, what price would you expect, at least a rough estimate of what price the ordinary Nigerian should expect that this commodity would be available to him or her?
Well, for one, just like you mentioned, since the deregulation and of the downstream sector, the removal of fuel subsidy, and since last year, we've not really, after the initial increase in fuel, we've not really seen that much increase, and this is even despite the fact that there's been an uptrend in crude oil prices and even depreciation of naira. So, like you mentioned, there might be some things going on, but eventually, we think that if the price of PMS now is still around what it is, it ought to have been more than this. If you have to look at other variables that are feeding into the determination of PMS price, but from Dangote Refinery will be able to, remove the pressure from getting FX, and also that means that these oil marketers will be able to get this oil without get the refined product without necessarily depending on the involvement of NNPC. So eventually, if we are to reach a price for petrol right now, it will depend on what Dangote and Dangote Refinery would, the price Dangote Refinery will agree with the oil marketers. But if there should be a moderation, it shouldn't be quite substantial from what we are currently seeing in the market right now.
So from what you're saying, NNPCL's involvement would either be reduced or totally removed. There won't be FX pressure. So what about the depot owners? I'd like to clarify that. Now, if the marketers buy straight from Dangote, doesn't that eliminate depot owners from the business? Because if Dangote is going to supply all that we need and I'm a marketer and I can directly go to Dangote to buy, then that puts depot owners out of business. Is that true?
Okay, thank you for your question. Depot owner, they'll still be within the value chain, not necessarily removed out of the value chain, but before, where they are able to play a very big role by also putting some margin or some sense of expenses to the prices. They won't be able to play that much in the space right now, because the independent the IPMAN, that's the association from the oil marketers, they are having a bulk agreement directly with Dangote Refinery. But definitely we still need the depots to be able to distribute this product across the country efficiently, because without the depots there will be timeline disruptions. Okay. And also even seeing that the road network, transportation network in Nigeria is not quite efficient, it might also impact how fast these products can reach their end users eventually. If the depots are removed, it means we are looking at more scarcity in the near term. from the recent happening where there was scarcity, and it was due to the fact that there was a bit of issue with one of the depots, which eventually led to scarcity in the downstream sector.
Okay, we are still going to look at the issue of the current scarcity situation that we're faced with now. But quickly, Nigeria has not been able to meet its OPEC plus quota. It wasn't even able to meet the volume of required, production by Dangote to refine at some point. And Dangote allegedly started to source for crude from the international market. So how sustainable do you think this will be at the long run if production levels don't improve?
Okay, for Dangote sourcing its crude needs outside the country, for one, we know how the upstream oil and gas sector work. Many of the contracts are already predetermined, and the upstream companies will have to fulfill and honor those contracts. Many of these contracts are like forward and futures contracts, and they have to honor them because they're already like in agreement with other crude buyers. So for Dangote to have resorted to getting the crude from the US, we do not see the continuation of that happening for a long time, because definitely the crude produced in Nigeria will be able to meet the production needs of Dangote and other refineries in the country. I mean, even before Dangote got the 2 million barrels of oil from the US, the country already supplied about 6 million barrels of oil to the refinery. So I believe that eventually when production should kick up, I mean, there's been a lot of reforms from the government about shoring up our production levels. We know how much the government has been doing to also improve like insecurity in the areas where that is impeding like the production levels. I mean, if we should see investment as well, more investment into the sector, upstream sector, I mean, across value chain, it will also improve how much oil production the country will be able to offer, and that in that line, Dangote would eventually have to like get the oil, most of the crude needs in the local market instead of resorting to international markets.
Okay, so let's now go back to the issue of fuel scarcity that you mentioned a while ago. Now, we see that it is gradually returning, and Nigerians seem to be in the dark as to why. Is it because of the ongoing price negotiations? Because some Nigerians are saying that, if there's going to be a hike in price, that the sellers or the vendors would hoard and sell it at a higher price. And a couple of weeks back, there have been speculations that because of the in-play of Dangote in the sector, that the price should come down. But still yet, we're seeing a scarcity at the pump. So why is that? And should we even be experiencing scarcity at this time?
Okay, truly, we shouldn't be experiencing scarcity at this time. But the issue of scarcity came up with one of the issues, one of the depot, but NNPC has clarified that the issue has been resolved, and petroleum products is expected to like flow into the local market very well right now. But when we look at Dangote refinery eventually, now the refinery is producing with a capacity of 350,000 barrels per day. But eventually, if the refinery tilts closer to its full capacity, installed capacity of 650,000 barrels per day, we expect some level of economies of scale to happen in that end. So as such, the higher the output, the lower the cost per cost of production, per average cost of production. So that means that prices would, in the long run, maybe not eventually now, prices will eventually like moderate a bit, not so substantial. And also looking at the fact that Dangote would Dangote refinery is expected to like continue increasing its capacity. I mean, there will be enough products available for the local market, even enough outside exceeding local demand, and there's the possibility of export outside Nigeria as well.
Okay, so let's still talk more about around the issue of the output, how it would affect output, cost of production, and pricing. Well, I'm sure you know that a modular refinery is simplified refinery requiring significantly less capacity or capital investment than our traditional full-scale refinery facilities. And a $1 billion fund to support indigenous refinery projects has been proposed. So do you buy into the idea of investment along these lines to further improve Nigeria's refining capacity, which may also in a way help in reducing the price?
Well, generally, in recent time, there's been a reduction in investment in the Nigerian oil and gas sector across the value chain. But with recent reforms and policy direction, we might begin to see interest from investors in the sector. But we know that the refinery itself is quite a cost-intensive project, like you mentioned. But there are various ways that the government can actually use to incentivize more refineries in Nigeria. There's streamlining of the regulatory processes and even offering like some sort of grants for refinery construction. Like we have even the government themselves have the Port Harcourt refinery has started production this May with about 60,000 barrel per day processing capacity. So we just expect that more focus, there's need for more reform from the government's arm. Like there's need for more focus on insecurity, because this will go a long way in encouraging investors, not just for the refinery, but also across the value chain, the upstream as well.
All right, Esther Otusanya, Senior Investment Research Analyst at Meristem Securities Limited. Thank you so much for helping us understand this better.
Thank you for having me.
When we go on a break and return, we'll look at the last discussion for the day. And of course, we're going to South Africa and look at the electricity value chain and what can be done to improve it. We'll be back. South Africa's electricity woes may be easing with a significant reduction in load shedding compared to last year. This positive development is attributed to a complex interplay of factors, including a decline in electricity demand and a growing trend towards alternative energy sources. While unplanned outages have decreased, the good news is tempered by a rise in planned maintenance, keeping overall electricity availability similar to the previous year. However, customers are experiencing relief due to a significant drop in the frequency and intensity of load shedding. From Johannesburg, South Africa, I have Chris Yelland, Managing Director, EE Business Intelligence, and he will be shedding more light on this. Thank you so much for joining us, Chris.
Pleasure. Thank you for having me.
Now, at the moment, unplanned outages are down. Is the overall availability of electricity actually higher this year compared to last year, considering increased planned maintenance?
No, well, you see, the unplanned breakdowns have noticeably reduced in the first 13 weeks of this year compared to the same period last year. But at the same time, planned outages, that means maintenance, has increased. Now, that's not a bad thing, but it does mean that there's less capacity available to meet demand. In other words, whilst people are doing maintenance, that generation capacity is not available for service. And the two are offsetting each other. So on the one hand, you have reduced unplanned outages, breakdowns, and on the other hand, you have increased maintenance, both of which are good things. But it means that the availability of generation plant is roughly constant. It's been about the same as it was for the same period last year. So people, of course, are asking, well, if the availability is about the same, why are we experiencing significantly reduced intensity and frequency of load shedding? And the answer actually is, if you look at the data, demand for electricity, and I'm talking here about Eskom electricity, grid electricity, demand for that electricity has been reducing every year for several years now, and it continues to reduce this year. And this is driven by a number of different factors. First of all, the very weak economy in South Africa, low growth, high prices of electricity that are rising fast, much higher than the inflation rate, causing customers to install their self-generation. That means rooftop solar PV, battery energy storage, both at domestic, commercial, industrial, mining, agricultural level. And so there's a move away from Eskom grid electricity, which is helping. It's reducing the burden on the Eskom generators. That means less load shedding. But there are other factors that are causing this.
Okay, so Chris, to what extent has the frequency and intensity of the load shedding decreased compared to the same period last year? And what does the new 16-hour load shedding approved for Eskom, what does it mean?
Yeah, so people have been a bit concerned that there has been recently a release of the new load shedding protocols. Now, previously, we only went up to stage 8 load shedding, which means up to 8,000 megawatts being shed at a particular time. Stage 16 really increases the level of potential level of load shedding. Now, one mustn't see this in an alarmist way. But the point is one has to be prepared even for worst case scenarios. We were pushing stage 6 load shedding last year. Sometimes even people felt that it was like stage 7 or stage 8. And so the planners felt it necessary to even start planning for beyond stage 8. But that's not to say that it's happening. And in fact, the load shedding has reduced this year. But one needs to put in place plans even for unlikely emergency conditions, and this is what we see is happening.
Well, you also talked about the reasons for the reduction in load shedding that has to do with improved maintenance. You talked about the less demand for power also. So then what about the new renewable energy and battery storage plants, which seem to be alternatives that people are also turning into? What contribution do you think that is also having on the reduction in load shedding?
Yeah, it's making a very significant contribution at a number of different levels. So, for example, last year in 2023, something like...
Hello, Chris.
So it's definitely helping.
Yeah, Chris, we didn't quite get what you said a while ago. Can you please just go back on it and let us understand better?
Yeah. Sure. So in the last year, that's 2023, something like 2,000 megawatts of rooftop solar PV and battery energy storage was installed. Now, that is relieving load shedding significantly by 2 stages. And it's not just, rooftop solar PV that's coming on. It's also the utility scale, large renewable energy plants. Wind, solar, battery energy storage is about the only game in town at the moment. Other options like new coal, gas-fired power, nuclear power, well, some of those will probably never happen, but the point is they're also very long-term solutions. So what we're seeing here is the private sector stepping in and looking after itself by building self-generation plant, as well as wheeling of power and trading of power through the electricity grid, using the grid as a transport mechanism for transport electricity from independent power producers to off-takers or customers of electricity.
So at this point, a lot of people are actually concerned about the state of Eskom, which is of course a public utility in South Africa. Do you think that this issue or this stage of load shedding in the country would speak more to a solution for Eskom in terms of its operational and financial strength, or do you think it will further make it redundant?
Look, the restructuring of Eskom from a vertically integrated monopoly that was set up about 100 years ago is in progress. And it's being driven by poor performance at a financial level, at an operational level, and also at an environmental level. And Eskom's level of debt is simply unsustainable. It cannot meet the debt repayments, both capital and interest, without very significant shareholder support. That means the government stepping in and bailing out bailing out Eskom. So the restructuring of Eskom is really very necessary. But again, this is not a short-term fix. It's going to take maybe 3, 4, 5 years for these reforms to take place. But they are very necessary reforms in the medium to longer term.
Well, you just talked about the public utilities debt being unsustainable and the need for restructuring. But we know that Eskom's financial struggles of late have temporarily been alleviated by the government in terms of bailout and a moratorium on new debts. So how much of debt relief has Eskom received from government, and for how long is the moratorium on new debt expected to last?
Yeah, look, at the moment, Eskom is receiving about 50 billion rands of bailout every year from government. Now, government has put in place very stringent conditionality attached to this to these bailouts, and one of the conditionalities, for example, is that Eskom must restructure. In other words, it cannot just expect to continue receiving bailouts from government on an ongoing basis. It has to look at the underlying issues, and many of the underlying issues are actually structural issues that need to be dealt with.
So still talking about the issue around restructuring, we have heard of talks around unbundling Eskom and increasing participation from private investors in areas of generation, transmission and distribution. Do you think that in a way would help improve Eskom's operations and put it in a better stead?
Yeah, I think it is very necessary. That's not to say that Eskom is going to disappear, and Eskom is not being privatized, but the private sector is being encouraged to participate in the electricity sector alongside Eskom, and also to provide the necessary finance, construction skills, and the building of new transmission grids, as well as generation plant. And really, the role of the private sector is really important, if Eskom is going to transition. But as I say, that doesn't mean to say Eskom is going to disappear. It'll always be a big and important player in this game. But we're looking towards a more diversified and more resilient generation sector that is competitive, that allows not only Eskom generators, but other generators, both public-private partnerships, municipal generators, independent power producers, and even customers of electricity to become part of the solution. And to supplement the electricity needs of the country so that it doesn't all fall on Eskom's shoulders.
Okay, finally, Chris, talking about solutions, let's look at it this way, and this is how we are going to end. Now, energy experts say that the success of the ongoing reforms in the power sector as it affects Eskom hinges on the passage of the Electricity Regulation Amendment Bill. Do you think that would be crucial for the future of the industry and, of course, the growth and viability of Eskom?
So right now, there is a bill that is going through Parliament. It's called the Electricity Regulation Amendment Bill, and it really is there to set the legal policy planning framework for an unbundled and a restructured Eskom. This bill has been through Parliament, it's been approved by the National Assembly, is now going through what is known as the National Council of Provinces. And we are reasonably optimistic that in the next few months it will be enacted as law, and it's really important for this bill to become enacted because it does set the legal framework, the planning framework for this restructured industry, which is absolutely vital.
Okay, Chris Yelland, Managing Director, EE Business Intelligence, thank you so much for your time.
It's a pleasure. Thank you.
All right. So that's the size of our package on the show Business Edge for today. Don't forget that you can visit our social media handle. We are at News Central TV. You can also visit our website www.newscentral.africa and equally download our mobile app on App Store and Play Store. We'll be back tomorrow 11 a.m. West African time to look at all the business related story as it affects Nigeria and Africa. Until next time, I am Lekan Onabanjo. Enjoy your day.